Hi everyone, it's Christian from Serene Education. Going to be doing the four majors for the second week of April, so that's the 5th to the 10th of April 2015. So, long weekend, Easter weekend. I hope you had a fantastic time with family and friends. So, just looking at this week's analysis, let's have a look and see how the actual month of April has panned out so far. So, I'll start with the Euro against US dollar on the monthly. Clearly, we're seeing a lot of negativity for this particular pair. And it has fallen drastically over the period of 2015 since the break of that institution moving average, which happened to be a major support and resistance level for the past 4 or 5 years, in fact. So December's close, we saw a lot of negativity through January, hesitation through February. We saw a lot of February movement going sideways, a lot of hesitation. However, looking at March, we saw some movement to the downside eventually. Looking at April, we've seen consolidation, particularly with the first week of the new month. You'll notice that, get a signal, we noticed that the first week of April we saw non-farm payroll figures. That was last week Friday, which came out very negative for the US market. In fact, I think they only created, if I'm not mistaken, 126,000 new jobs. So the forecast was for 246,000, came out 126. So a major shortfall of there, 120 odd thousand jobs from the forecast. So not really good for the US market. And we saw Euro and all its cross pairs against US dollar mounting a slight pullback on that news announcement. Having said that, however, just looking at the current weekly candle, you'll notice that we haven't seen price actually making any new highs. Clearly not making any breaking last week's high, in fact. So clearly through Sunday evening's trading, the open of Sunday evening's market trading, through Monday yesterday, going into today, clearly no new highs being breached or made on the Euro against US dollar, even after that negative news outcome for non-farm payroll. And that level over here is predominantly the same level that we saw as consolidation back in early January of 2015. So the overall bias, looking at the indicator box, is still one of negativity, and the R-squared is complementing both that negative sentiment we're seeing on the monthly and weekly time frame for this particular pair. We have seen consolidation, however, saying that we've seen three prior weeks of movement which has failed to make any new highs. We have seen body highs, but the overall bias is still failed to break the current high of each of those weeks in order to make a new swing high. So ideally we're still looking for that to be the case if we're looking for any further Euro US dollar positiveness. So if Euro is to make any further headway to the upside, then ideally we want to be seeing prices making new highs. So ideally above that 110316 level as a start would be a good defining. So when we drop down to the daily time frame, there we go, you can see the 50 period moving average on the daily acting as a nice clear resistance for price. You'll notice that non-farm payroll, we saw a nice bullish candle on Friday after Thursday bias, and also on Wednesday we had ADP non-farm figures that came out, which were also negative for the US dollar, which pushed Euro high on that, and we saw that momentum building up as we head into non-farm payroll Friday, and subsequently we had that play out. Then on Sunday we had an indecision candle, and Monday you can clearly see we saw a bearish engulfing candle, so almost like an evening star formation here at resistance level, and prices pulled back this morning. So if we fail to see any further highs on this particular pair, then we could be looking towards the current support level at the start or midweek of last. So that'll be Tuesday and Wednesday's lows of last week at 107.352 as a potential target intraday for any of those intraday traders. And then if we see that level being breached or closed lower, then we could be looking at the lows that we saw at the start of March as our second target. So as it stands at the moment now, between where price is trading right now to the current first target level, we're looking at 120 odd pips, but ultimately way down to those March lows, we're looking in excess of 390 odd pips. So there's movement to the downside if we don't see Euro making any new highs. Okay, so we've seen Euro primarily making a bit of headway because of negative figures out of the US market. However, saying that, Eurozone in its own right is still seeing some uncertainty out there. Greece is no closer to actually coming out with any idea of what it wants to do, and that's still going to be a major talking point for Europe as we go on into April and any other months preceding that. So it starts to get a bit worrying now. The longer that Greece starts to kick the can down the road. So the most important factor here is we're going to have to look at Eurozone overall, and the major issue we have with Eurozone overall is Greece. So the continuing issues with Greece will have a negative effect on Eurozone. So we've seen some positive headway for Europe, primarily because on the back end of US negative data. Okay, so even that's great. It's short and sweet and to the point. So primarily people are just pretty much trading the outcome of those news announcements, but they're not keeping those positions long. They're pretty much going in quickly, taking aggressive targets, and pretty much taking all that profit off the table when they get to those targets, and price just pulling back when we get to there. So we're seeing movement on the market here, which is short and sweet. Okay, and that's reflective of any important data out of the US market. The overall bias for Eurozone is negative at the moment, so we should still be looking for that negativity on Europe going forward. Moving on to sterling, here again, just looking at the monthly time frame, you could see that March we had a major bearish engulfing candle after 2 prior months of consolidation. Okay, and this consolidation is taking place at a prior major support and resistance level, which happens to be this consolidation level we saw back in 2013. A noticeable consolidation level of roughly around 7 odd months, and you can see that price actually was very negative into that level. However, we saw consolidation through most of February, and then going into March we saw a nice bearish engulfing candle close lower. Here again, like its European counterpart, we haven't seen any new lows going forward for the start of the new month of April. So we're looking for prices to close lower than the body close of March to see a continuation to the downside. The overall long-term bias is still one of negativity, but you can see that the R squared is now not really complementing any of that negative sentiment that we're seeing on the daily, the 4-hour, the weekly, the daily, and the 4-hour. Okay, so bearish engulfing candle, which is a good sign. We could see some consolidation, so we had a breakout. We could expect a pullback, whether it be a shallow one, if not as such. So if we look at the pullback resistance level at 150666, if we keep that as a marker in the sand as a potential, if we do see a pullback after the breakout that we saw at the end of last month, breakouts, pullback, and then a continuation. So the pullback, as long as she's capped by the 150666, then we could see a continuation going into the end of April and the new month preceding that. So drop down to the weekly. You can see a lot of hesitation has crept into the market, but this is primarily because we're trading at prior support and resistance level lows that go back to that early part of February, as I mentioned. So if you look at the weekly candles, a lot of indecision candles, and those bodies have failed to make any new highs over the past 3 weeks. So the bias is still very much indecisive for sterling against the US dollar. We did see a bit of headway last week on the back end of that week data that came out on Wednesday, followed by the week data on non-farm payroll on Friday. Having said that, though, it's failed to take the momentum further and to drive and to make a new swing high. So we've seen consolidation, but she's failed to make a new swing high. In fact, all we've seen is price consolidative. So the past 3 weeks, in fact, we've seen consolidation, and that should be mirrored on our daily time frame. A lot of hesitation, price moving sideways, no new highs, not even worth trading. I'd rather just keep the high and the low of that weekly range and wait for a breach candle, whether it be up or down, and that's it. Rather give that to the market. If we've not seen any movement on the weeklies, then look at a weekly breakout to really give us a bias, bullish or bearish in the direction. The overall bias is still negative for sterling, so therefore we still put more emphasis on the negative breakout to the downside. Having said that, though, the longer price consolidates going sideways, then we're likely to see more bullish bias coming into it. So here, to stop that speculative movement, all we do is go back to the weekly, draw high and low, cap it, and wait for the breakout either way. US dollar Swiss franc, looking at the monthly time frame here, you can see a lot of indecision has crept into the market. We've seen a lot of hesitation, primarily what happened with the Swiss National Bank in January. But having said that, we've seen prices pulling back and taking back most of that negative sentiment. Having said that, though, we saw prices pulling back sharply once you tested the January high. So if I drop down to the weekly, you can see, just taking the body high of January, you can see that the momentum going into the latter part of February, we saw prices rallying aggressively into those levels, the January level high, however failing to close higher. And what happened was, we saw a lot of people taking their profit as we headed into this level. So clearly people were looking to make a bit of profit on the back end of the US dollar rally against the weak Swiss franc as such. However, they did have a clear objective that the prior highs, the January highs or the December highs, was going to be their overall target. And when they got to that level, people were just going to literally close their accounts or their trades, and clearly that's exactly what happened, because as we headed into that level, we saw a lot of profit being taken, which led to this bearish engulfing candle formation over that week, and subsequently that's now put bias or negative bias back on a pullback for the intraday time frame. So bearish engulfing candle on the weekly constituted to bearish sentiment looking forward for the coming months, the coming weeks, and we saw the 23.6 fib level being breached, and prices last week in fact heading towards that 38.2 level here at 94.20, not clearly getting to there. And what it's done now is you can see that after non-farm payroll figures on Friday, we saw negativity for the US Swiss franc pair. However, heading into the institution moving average and through closing on the institution moving average on the Friday close, and Sunday evening not really much giving us anything back. And then we could see this Monday and Tuesday, we've seen the US dollar creeping back a bit. She's got to then get back above the 23.6 fib level here to constitute for price to then reattempt the highs that we saw through March, early March in fact. So very, very important. Now you can see the bias, especially on the long term, is still positive. However, you can see that the R squared is not complementing the weekly time frame as such, because we're pretty much trading within a very speculative consolidative range. So ideally here, also same thing, break below the institution, we would see further extensions to the downside. Get back above the 23.6 level, then we could see price or the US dollar reattempting the highs that we saw through the early parts of March. So here, rather would like to see a signal, a genuine signal candle before proceeding any further. US dollar Japanese yen, the last pair of the analysis, you can see just looking at the monthly, prices still failed to make any new highs. Having said that, she's failed to make any new lows. So the overall bias of here is still one of upside. So still looking at the indicator box, the bias is still very much to the upside. However, weekly and daily we're starting to see a lot of indecision, and that's primarily because price has not made any new highs. It's just kind of gone sideways. And if you look at the overall bias, you can see that the monthly 1, 2, 3, 4, the best part of the last 4 months or so, price has been consolidative at an area which in the past, at 2000, 2006, 2007 levels, has been a major support and resistance level. So consolidation at a prior major high. So looking forward, we would want to see a continuation candle, because if this is US dollar strength against the weak yen, then we would like to see price making a new high in order to then enter, and then we could target prior highs to the upside. Ideally, we could be looking at that level over here, around about the 134.87, and then ultimately way back to those highs we saw back in 1996, 97, which is way up here at 145.100 and change. So there's more than enough on the table here to see a genuine return in time invested. But what we don't have is a continuation candle. Body highs, clearly no movement to the upside. When I drop down to the weekly, you can see that we've been in a consolidative range. And you can see that price in February attempted the highs we saw at the back end of October going into November. Saying that though, on the pullbacks, prices failed to make any new lows, and none of that negative sentiment has really creeped into push price lower. So it tells me that the bias is still looking for upside US dollar strength. However, we haven't clearly seen the big boys coming to the table, and that's all that's missing from this particular pair, is that movement. So what we're going to be is patient. Apply patience. I'm afraid we've got to wait for a nice bullish breakout of the current highs to then give us an idea that we're seeing a genuine long-term continuation with trend, and then we could target to those levels for the foreseeable, for the remainder of April going into the months preceding. Having said that, if we don't see any new highs created this month, then ultimately we're still likely to be sitting in a consolidation. The problem with consolidations or trading consolidations is the risk goes up tenfold. Just drop down to the daily. You can see here, just looking at the daily over the past couple of months, in fact, you can see how indecisive price has been. Risk becomes a major issue, because when you start looking at genuine entries, by the time you factor in all your risk, you're literally risking far too much of your portfolio in order to make a short, undecided, or uneducated guess. So we don't guess. We'd like to see genuine movement in the market, and then we'll trade that. Ideally, we want to be trading trends. We don't want to be trading consolidative ranges. If you choose to trade consolidative ranges, know the risks involved. Well, that's all I'm going to say. Okay, that's entirely your choice. Here again, US dollar Japanese yen, not my favorite pair at the moment now, because the price has just been consolidative. I'm not willing to risk any opportunities on this particular pair as long as she remains within this tight range. Okay, so here again, box and tag and wait for a nice clean breakout and then trade the outcome. Okay, so have a look at any yen crosses for further movement going forward. Very, very important, but as it stands at the moment now, we're looking for continuations with current trend. So here again, just apply patience and you shall be rewarded. Okay, and then just back it up any opportunities that you might find with genuine with proper money management, and you should be on a winner. I'm going to leave you with that. Until then, you guys trade serenely.